Hello all, and thanks for tuning in to this month's Market at a Glance video update. February was another interesting month in the global financial markets. The S&P 500 increased during the month amid a decline in new COVID-19 cases and signs of increasing consumer and business activity. But these signs of improving economic conditions sparked concerns about higher inflation. This drove the US Treasury bond yields higher, and in turn, fixed income markets declined. Meanwhile, the unemployment picture continued to improve. The Labor Department reported that U.S. non-farm payrolls increased by nearly 380,000. Job gains were particularly strong in the leisure and hospitality sectors as pandemic-related restrictions eased. The unemployment rate modestly decreased to 6.2%. However, the labor participation rate, which is the percent of Americans employed or seeking work, remains at a generational low. The pandemic has forced many to leave the job market. COVID-19 vaccinations reached over 240 million doses across more than 100 countries. The U.S. Food and Drug Administration authorized Johnson & Johnson's single-dose vaccine. There are now 3 vaccines approved in the United States. Finally, we return to the inflation conversation in our chart of the month. In this chart, we look at break-even inflation rate. This data point reflects market expectations for the average inflation rate over the next 5 years. It is measured as the yield difference between the U.S. Treasury securities and the U.S. Treasury inflation-protected securities, also known as TIPS. In February, the 5-year break-even inflation rate increased to 2.4%, which is its highest level since 2013. This shows that investors are starting to expect higher inflation rates soon. To learn more about February market and fund performance, please check out our monthly investment report, which is now live.